Assalamu alaikum friends, welcome to lecture 14 of AFM. This is the last lecture for your accusation and merger. Because after this, next lecture, which is lecture 15, will be on reconstructions and reorganization. Okay, in this lecture, we are going to talk about how do we finance accusation. There are three ways how we can finance, and this three will be asked in your exam. Whenever an accusation and merger question is asked, finance, how do you finance accusation is definitely asked. It is definite question you are going to get if you get an accusation and merger question, and which is very, it's like, it depends. See, if you are getting risk management is one question for sure. Okay, one is net present value question, that is your investment after sale, but the other question could be your reconstruction or accusation merger, or it could be both in one. So it depends. Okay, one, cash offer. You either can acquire a company by giving them cash, or share exchange, where you are going to give them your company share, and mixed offer. Mixed offer is the combination of cash and share. Plenty of questions are there, past paper questions are there on this. You will find enough. But in this lecture, we are going to do 5 questions in total. So starting with cash offer. Cash offer means you are giving one fixed cash large sum. Okay, it's fixed. Okay, and is huge. Second, this method is relatively suitable for small accusation. Why? Because for big accusation, you need a huge amount of cash. And most of the time, most companies do not have that huge amount of cash at hand at the moment. They might have to borrow from outside, or they might have to use their retained earnings, right? We'll see later on how to finance the cash offer. How do you get those cash? That also is there. But for now, just know that for small accusation, cash offer is suitable. Okay. Now, what are the advantages of cash offer? Number one advantage is this can be done quickly and at low cost. If the bidder has sufficient cash, then only. If you have sufficient cash, give the cash, take over. Finished. Second advantage is target company shareholder have certainty how much they are going to receive. Because it's in cash, no? Cash is a fixed sum. We know if it's 10 million, we know 10 million at least we are going to receive. So risk is less there. But if you are going for the share offer, it's a risk there. Because you don't know tomorrow what will be the share price. The value keeps changing in the share, but cash is not like that. Third, we know cash is more liquid than shares. So this will increase the liquidity of the target company shareholder. Okay. Fourth advantage is, what is it? The acceptable consideration is likely to be less than with the share exchange. In terms of target companies, they also want to go for the cash. Target company shareholder might want cash offer to be more acceptable than share offer, because for them it's less risky. So overall, what happens? This reduces your cost. For the bidding company, the one who is acquiring, for them, overall cost is reduced. Right? Now coming to the disadvantages of cash offer. First disadvantage. Remember, the larger the accusation, more you have to borrow. And if you borrow more, it increases your gearing, and hence your financial risk increases. Right? Second, tax. Tax. If you are selling something in shares and you are having a case, you are raising a cash, on that you have to pay tax, chargeable gain. This comes from your taxation. If you have a knowledge of taxation, you will understand. Anything that you are selling, you are getting, if you are selling shares, you know that you have to pay tax. Chargeable, taxable, it's a taxable chargeable gain. You have to pay capital gain tax on that. But if it is for share, okay, if it's share offer, share for share exchange, you don't have to pay tax because it is on a paper based that shares are exchanged, nothing in cash. No cash is changing hands, so you don't have to pay tax. You can delay that tax. Third disadvantage is, for target company, they might be unhappy with cash offer. Why? Because cash offer will not give them any ownership or any right to participate in the bidding companies, right? But if it's share for share exchange, You see, they also become owner of that company. They can become shareholders of the bidding company, the target company. But cash, once you accept it, that's it, gone. You cannot take any decision in the, you cannot participate in any decision making of the bidding company. The control is not yours. Full control remains with the bidding company if it's cash offer. Now we go to methods of financing this cash offer. There are two methods. One is raising debt. Through debt, you can take this cash. Even this is a very popular exam in your AFM, which you have to know. If you are learning acquisition merger, this lecture is a must. Everything in this lecture is must. Okay. Debt. You might go to bank, get a loan, or you can issue bond, right? Advantage of this is you can easily get debt. Debt is at low cost. We know that interest on debt is tax deductible, so you can save on tax. We know that, right? Second, disadvantages of using debt finance is what? It increases your gearing. Bidding companies gearing will increase. I mean, how much can you keep on taking debt? It increases up to a point, right? After that, financial risk increases. So because of that, this will not be acceptable to all the shareholders. Now coming to the second, which is right issue. Right issue means you are giving the existing shareholder the shares. Okay. So in this case, you are not suffering any increased risk. In debt, you are suffering an increased risk because gearing and all. Here, you are not facing that risk. Okay. So in this case, company's gearing is not affected. But remember, having right issue will affect your earnings per share. That will fall because you are issuing new shares, no? From your earnings per share, your shares are reducing. So your earnings per share will fall. Second, from the shareholder's point of view, okay, if you think from the shareholder's point, why this is a problem is because they should have the money to invest also. They themselves should have the money to invest if they're issuing right shares. Now, coming to the second, that is share offer. You can go for share exchange also if you have to acquire a company. Not necessarily you are giving cash and buying it. No. In this, what happens is bidding company issues some new shares and then they exchange them with the target company shareholders. So what happens at the end is the target company ends up having shares in the bidding company. You understanding? Large acquisitions often involve this only. For large companies, they have this only share exchange. Advantages. Number one advantages is you don't have to raise cash immediately. Okay, you don't have to raise cash to make the payment. You're not making the payment immediately. This is share exchange. You're just changing shares. Second, for the bidding company, the one is acquiring, it can bootstrap EPS, especially if you're having a higher ratio than acquired entity. If you, bidding company, has a higher PE ratio than the target company, okay, by through share exchange, you can have bootstrap, you can increase your earnings per share. If you're not understanding how, through a question, I will show you how. I will demonstrate how you can bootstrap your earnings per share with a higher PE ratio. We'll show you this. So in short, the one who has a high PE ratio is going to have the benefit through share offer. Third, shareholder capital is increased, isn't it? Even your gearing will improve. As the shareholders of the acquired company now become shareholders in the post-acquisition company. Share exchange can be used to finance very large acquisitions, yes. Disadvantages on the other hand is, what is the disadvantage? Now, the bidding company shareholder have to share any future gains if they're making with the target company shareholder. So this will reduce your control and also share in that combined entity. Earlier, you alone enjoyed everything, whether it's a loss or a profit. Now you have to share that profit. Control is reduced because in that combined entity, even the target company shareholder will have a control and share in profit. Second, price risk. Do we know what is happening to the share price? It can go up and down. There's always a risk. We don't know what is happening to the market price. So bidding company shares might fall also during the bidding process. Okay. For example, if 1-for-2 share exchange is offered on the FAT, that the bidding company shares are worth approximately double the value of the target company share, okay, the bid might fail if the value of the bidding company shares fall before the acceptance date. Okay, if you're not understanding this, don't worry, we have questions to show you this. Okay, now what are the key issues relating to the form of consideration, whether you have to go for cash or share? What are the things? This is also very important from the point of exam. You have to write, remember, in acquisition merger, not only valuation, not only calculation, not only which offer is the best by calculating. No, you have to write. For discussion question, I've involved these things, included these things. Number one, position of the target company shareholder. Which offer will make the position of the target company shareholder better? That offer has to be chosen. For example, okay, if the target company shareholders' intention is that they want to retain interest in the business, cash offer is not suitable for them. They will welcome share offer. But remember, with cash offer, there is a greater certainty of value for the target company shareholder because share prices fluctuates, but cash prices will not fluctuate. Understand? Second, position of the bidding company's shareholder. From their point of view, if bidding company issue new shares, okay, they requires consent from other shareholders in the general meeting. And also it means you are giving up your power. Your ownership is diluting. If you are okay with it, share offer is for you. If you are against it, it's not for you. Okay, another key consideration is what would be the impact of the takeover on the bidding company's financial statements. For example, you are issuing new shares. Okay, issuing new shares will reduce your earnings per share. Know this. And earnings per share is a key performance measure that is used by market analysts to analyze your performance. Okay, but if cash offer is made, you need to raise a significant, you need necessary cash. You have to raise that necessary cash either by right issue or debt, which can have a significant impact on the gearing of the bidding company. So both the ways is having some problem. Cash will have issue on the impact on the gearing. Shares will have an impact on the earnings per share. This you have to understand because they might give you, they might present you in the exam with the financial statements of the two companies and tell you to show the impact. That is basically you have to change the financial statements, right? Now, how do you evaluate a share for share exchange? This is how you do a question on this. Okay, number one, this is the procedure. You start with finding the value of the bidding company as an independent entity. That means do not think about accusation at all. When they were independent, what is their value? Value means calculate the value of share in that company. Second, do the same thing for the target company. Target means victim. Target is also known as victim. Okay, target company. Then you find the value of the combined company. This is how it is done. Value of the predator, that is value of the bidding company plus value of the target company. You add both, which will give you, with this you add synergy. In the exam, synergy will be given to you. If there is any synergy benefit, they will give to you. In the exam, it will be given. Don't worry. That you have to add. And the value that you get is known as the total value of combined company. This step does not stop there. After that, you have to calculate the number of shares. How do you do that? Post integrate. That means after accusation, you have to calculate number of shares. First, the number of shares that is in the predator company originally. That means the bidding company. The share that you have issued to the victim company, add, will give you the total shares. This is what you have to use in the exam. Okay. And at the end, you have to talk about whether the wealth of the shareholders after the takeover increased or not. How will you tell this? You see the shares, no? You see the value of the share. So you calculate the value of the share in the combined company and see whether before the accusation and after accusation, how much the value increased. If there's an increase in value means there is a increase in the wealth of shareholder. Shareholder wealth has been maximized, otherwise no. This is how you decide whether an accusation is good or bad for the shareholder. That's it for this lecture. Now we'll be doing the 5 questions on both cash and share offer. So this is the first question. Here you are expected to calculate the expected value of a share in the combined company, assuming that the given share price has not yet moved to anticipate the takeover and advise. One is calculate, one is advise the shareholders in company B whether the offer should be accepted or not. Company A has 200 million shares, current market value is 4. Company B has 90, current market is 2. Market has an offer of 3 new shares for every 5 currently held in B. A has worked out that the present value of the synergies will be 40 million. Okay, remember you have to find the value of the combined company. And this is clearly it's a share offer. Okay, how do you start? Start finding the market value. Okay, market value of both the company. I'll be doing it on the right hand side. Okay, you do it along with me. So first we are going to find the market value of A, the market value of B. What is the market value of A and B? Just simply this into this and this into this. 200 into 4, 90 into 2. Okay, so 200 into 4 will give you 800 million shares. This is 900 into 90 into 2, right? 90 into 2, which will give you 180 million shares. Present value of synergy is already given as 40 million. So what do? Add all the three, 800 plus 180 plus 40, total. Total is 1020 million. Now find the number of new shares. How do you do that? See, always start with the bidding company share, that is 200. So with 200 you have to add, okay, the ratio you have to apply, the ratio 3 is to 5, 3 to 5 or 5 to 3, that you have to apply with the target company share, which is 90. This is always the rule of finding new shares. You cannot afford to make a mistake here. If you make a mistake here, your shares will be wrong, then your valuation, everything becomes wrong. Okay, now let us see the ratio. 3, A makes an offer, that means A is the one who is issuing 3 new shares for every 5 currently held in B. How many shares does B have? 90 million. For every 5, that means for every 5, 3 shares they are offering. Or you can take it the other way around, 3 is to 5 into 90. Like this also you can take it. They're offering 3 for every 5. So 3 over 5 into 90, or this is the same thing. Meaning is same. When you are doing it, this has to be done first and then add with 200, which will be 254 million shares. Okay, now let's find out. This is the way you find out. You put it in terms of table, because you have to find out whether there's a maximization of shareholders' wealth or not. So note down the shares, the market value, and the old wealth, and the change. How much shares did A has? 200. B, 3 over 5 into 90 into 90, that is 54 million. That's how we got 254 million, right? Market value is how much? Old wealth we can write 800, and here it is 180. But what about the market value? What about the market value? Tell me. Market value of A. Tell me. To find out, you have to do this thing. Total divide by number of new shares. That is 1220 divided by 254. How much? 4.01, or you can say 4.02 if you want to round it up, or if you want to take the whole answer. So this basically now you have to multiply by 200 because 200 shares for A. This is the new share price. Earlier it's 4, now this one into 200 into 200, which will give you 804. 804. Because you want to find the market like combined company. What about B? B is same thing. How many shares? 180. So 180 into, sorry, 180 is the market value. I'm sorry. It would be 90 into how much? Earlier it was 2. Now 4.02. How much? Wait. There is some. Yeah. It's not 90. Because remember we have 54 shares for B. B has 54. So you have to take 54, not 90. 90 is old. 54. 54 into 4.02, which will give you 216 point something. We'll see. It's exactly not 4.02. If you take the exact, or you can say 54 into 1020 divided by 254. Let's take the exact. You will get 216 point something. So let's take it as 216. Okay, because when you add up, it should be equal to 1020, remember. So you can get this as a balance also. The other way is 1020 minus 804. Because I know it's 217 is coming when you round up, but it should equal to 1020. Now, what is the change? Earlier it was 800, now it increased to 804 plus 4. Earlier it's 180, now it increased to 216. The change is 36. So you see, they should go ahead with this accusation because shareholders' wealth increased. Because if you see, they are asking from the point of companies B, it increased by 36, right? Out of 180. So the change is 36 out of 180. That is a 20% increase if you see. 20% increase in wealth. So companies B shareholders should be advised to accept 3 to 5 share for share exchange. That's how you have to write at the end, that they have to go for this because shareholders wealth maximize for shareholders B by 20%. Now let us go to the next question. This is a cash offer. Okay. A and B. So if A intends to pay 1.2 million cash for B, what is the cost premium? A share price does not anticipate the takeover. B share price of entity B includes a speculation element of 2 per share. Let's go by. And you have been given market price per share, number of shares, and market value. Okay, they just multiplied this by this and got the market value for both A and B. Now first let us do A. Okay. What would be the cost to the bidder? Think. Because they are asking what is the cost premium. If A intends to pay this much for B, what is the cost premium for B? Okay, they are paying it to B. Who is incurring this cost? A, because A has to pay, no? B is receiving the premium, but A has to pay. So for A is the cost of the bidder. How much? 1.2 million minus market value of B. This. Because they are paying more than the market value of B. This is the premium. Can you understand? So the cost will be 300,000, or you can say 0.3 million for A. Coming to B, there is no share price, okay? Just by the cash. Now the share price is 2 per share. What will be the cost now? See, with the cash element, you have this. So cash, in terms of cash, we already calculate what is the cost. It is 300,000. With this, you have to add the share element also. How much? 2. 2 into 60,000, because there are 60,000 shares of B. Share price of entity B is 2. So 60,000. The share element also you are adding with the cash. So the total is 420,000 is the cost. The total cost for A. This is the premium that they are paying. Are you understanding? Entity is therefore really worth only how much? How much is the actual worth if you have to go by the worth? Tell me. See here, look at the price of B. It's 15, right? But in this 15, 2 is the speculation element of 2 per share. Speculation means they will expect that the performance of the company will improve or something like that. There is another element like that also. It's called as known as contingent payment. Based on some conditions, if it is fulfilled, you have to pay. Something like that. So the original share price will be 13 then. Minus 2, then is 13. So 13 into 60,000, how much? 13 into 60,000, because share is 60,000 for B. This means the B share is worth actually 780,000. Understanding? Now let us go to this share exchange for the same question. Same question or it's a different question? It's the same question. Calculate the true cost of the takeover to the acquired shareholder. Suppose A offers 16,000 shares. How 16,000 shares? They have shown you how they have got 16,000 shares. 1.2 million divided by 75. Right? Instead of 1.2 million cash, they are going for 16,000 shares. Now, the cost appears to be 300,000 as before. But because B shareholdings will own part of A, you see, now because of share exchange, B shareholder also will have some part of A. So this they will benefit from any future gain of the combined entity. The benefit will go to B shareholder also. So now their share will be how much? How much will be their percentage of shares if you have to find out? 16,000 you're offering. So that's why 16,000. Divide by 16,000 plus what? How much shares they have? Go up 100,000. With this 100,000 here, with the A is the acquirer company shares only you have to add always. Okay, with the share that you have issued. So 100 plus 16. It's not the other way around. Don't add 60 with 16,000. Target company shares are not added. So out of this total share, 16,000. So this is the percentage, 13.8%. Okay. Suppose that the benefits of the combination had been identified by A to have a present value of 400,000. Let's say, for example, suppose this is the benefit. A thinks that B is really worth this much. 900 because they have early calculated 900. With that, they have added 400 also because the benefit of the combination. Therefore, the combined entity of A and B is worth this much. This 1.3 from B and 7.5 as it is. Because A is 7.5, you see here. Market value. Okay. Which is 8.8. Now, calculate the cost. So, the combined company's value you can say is 8.8. Now, based on that knowledge, you have to find out what true cost of takeover to the acquired shareholder. Even if they say acquired shareholder, you have to find out the target company shareholder also. Okay. So now, first we are going to estimate the prices, okay, for A, B. What is the proportion of ownership? Understand this. If you get a similar question, this is how you need to do. First, find the proportion of ownership in A and B. B already you have found out, 13.8%. So balance is for A, which is 86.2%. Now, market value. What is the market value? 8.8. Combined company. With this, you take the proportion. For A, 86.2%. For B, 13.8%. Okay, take the proportion. If you take for A, it will be 7.586 million. If you take for B, it will be 1.214 million. Coming to the number of shares. After market value, number of shares. How much? A as it is, 100,000. A's shares will not change, but B also as it is, 60,000. Now you have to find price per share. How do you find price per share? Simply market value divided by number of shares. So this will be 75.86. This will be 1.214 divided by 60,000, which will be 20.23. Understanding? Just take some time to go through this. First, you have to find out the price, right, for both the shares in A and B before you can actually work out the value or the cost. It's always like that. You have to find the price per share. Now, the cost to A, because that's what the requirement asked. Cost to A means what A has to pay to B, in fact. So you take the B company share, it is 60,000. Because obviously the market value of B, A has to pay at least. So 60,000 is the B shares multiplied with the share price, which is 20.23. This is why we need to find this price. 20.23. So the price will be 1,213,800 less the current market value. You always have to deduct the current market value. Current market value of B, this one, 900,000. This is before acquisition. And after acquisition, you're comparing. Which is 313,800. This is the cost to A. Cost to A, but benefit for B shareholder. Now we'll be doing, this will be a bigger question. Test understanding 3. You have to write here a lot. This is like an exam style question. So here you have been given the share price today and share in issue for both the company. Okay. Mayors want to acquire 100%. The directors are considering offering 2 new Mayor shares for every 1 power share. Evaluate whether 1 for 2 share will be likely to succeed. Evaluate. Whenever they say evaluate, advantages and disadvantages. Evaluate from all the angles. Okay. Don't just say, okay, it is successful or it is not successful. Don't give clear-cut answers like that in AFM. Do not give 1 point, you have to give maximum 5-6 points. Why you think it's likely to succeed or why you think it's not likely to succeed. Both the sides you have to give it. Answer has to be balanced. Not too positive, not too negative. And then finally you have to recommend. Okay, if necessary, recommend the revised terms for the offer which would be likely to succeed. If it is necessary. Otherwise, no need. For this type of questions, okay, where you have to give calculation and explanation, always calculate first. Okay. So first find the value of both the companies individually. Value for M company, value for P company. So you just multiply this two as it is. Dollar 3.05 multiply with the number of shares, that is 48 million. And here dollar 6.80 multiply by 13 million shares, which would be equal to dollar 146.4 million, 88.4 million. Now what? Total value. There is no synergy gain, because if there was synergy gain, question would have mentioned. So just add both the figure. Can you see the similar nature of doing questions? You will see a pattern of finding the value of a combined company. That's the reason I have included all the 5 questions. If you add both, it is 234.8. Now, always you have to find number of shares post acquisition. Because it will be different, because the number of shares that you have for M and P are different, post acquisition will be different. Okay, so now how? See, for M, I always told you start with the bidding company. Bidding company, there is no change, 48. Plus, for the target company, how much? 13 million. Okay, so they told 2 for everyone. So that means 13 into 2 for everyone means you divide it by 1. It's the same thing, 13 into 2, because if you divide by 1 is the same. So that's why in your answer you will just see 13 into 2. Okay, and you will get 74 million shares. With this, okay, what should you do? You have to find the share price. This is the number of share. You have to find the post integration share price also. So let's do that. How do you do that? I'm going little slow so that this thing stays in your mind. Okay, number of shares after acquisition you have to find out, share price you have to find out. Now you know this, also, so just divide it. 234.8 divided by 74, which will give you $3.173. Now using this share price, and remember you have to see whether the wealth increased or not, because then only you can give an advice. Okay, so for that table, same, I think we have done this question before also. We'll do it again. MP, shares, market value, old wealth, and the change. Old wealth as it is you can write, already we got 146.4 and 88.4. Shares, nothing will happen to M, it is 48. For P, it is just 13 into 2, so 26. Now 48 into this, based on this you have to take. So 48 into 3.173 will give you 152.3. And 26 into 3.173 will give you 82.498, or you can take 82.5. At the end you have to get what? Add both and see what is the market value you are getting. 234.8. Exactly this price, or exactly this price you have to get. Okay, now if you see from here to here, it increased by how much? Plus 5.9. If you do this in Excel, you can quickly do it, but here the value went down, minus 5.9. so the nil effect is 0. There is no change in wealth, neither it increased neither it decreased. So in this case, what do you advise? What should be your advice? I'm not writing the advice, I'm just telling you the advice. You can write it by yourself. And do you recommend or not? Some of you might say yes, because some of you might say no. But personally, if you ask me this question, my decision would be no. They should not accept this. Because even if wealth did not increase or decrease, but it will dilute your shareholding power. Your shares will reduce. And if you think it in terms of P company, they will not accept this. Right? Now, recommendation. What do you recommend? This is a very lengthy answer. If you read your answers, it's very lengthy answer, but I will give you in terms of point. And they are explained in different paragraphs. Each point in different paragraph needs to be explained. So first paragraph, first point. I'm giving you the answer in terms of point. You have to write it. What do you recommend? First, you have to start by saying that if they want, okay, in order for the P company shareholders to be encouraged to go for share exchange, their wealth has to be increased. Their wealth has to be increased. Wealth maximization you have to talk about. Wealth maximization of P companies shareholder. Second paragraph, second point. What is it? See, to make sure that M company is valuing P company, what should be the current market value? Or you can alternate the offer also. Remember, the value of the offer needs to be how much? 88.4. Offer needs to be at least 88.4 for M to value P. Because M is going to buy P, right? So at least it should be equal to this, their wealth. The offer should be at least this much, which is their current market value also. Third paragraph. What is the current situation? What is currently happening after this new offer? Tell me. Given the current M's share price, that is 3.05. This is the share price, right? 3.05. Is it or not? This one here for M company. So given that M company share price is this one, this is M company. I'm writing in bracket. Okay. How much this amounts to? Like how many shares using this share price? See the value, you will only value when it is 88.4 because this is like the current market value, right? The old market value. So 88.4 divided by this share price and find out how many shares, which will be equal to 28.98 shares. Okay, this much of shares it is equal to in M's company. Shares in M's company. Now, the fourth. So an exchange of this share for the 13 million power company share represents a ratio of, what is the ratio? For 28.98, how many shares? 13 shares in P company. It's 13 because they have told, right? 13 for 1. So 13. But you just change them company shares based on changing the offer. If you use this ratio, how much it will be? Tell me. Just divide both the sides by 13 and you will get it. It will be 2.23:1. This is the ratio. Isn't it? 2.23. So explain this. What is the impact of this? Will there be an incentive for them to go ahead or no? However, if the terms of the offer were to be exactly 2.23, imagine if the offer of the terms, for every 1 share in this one, there will be no incentive for them to sell. There will be no incentive for P company shares to sell the shares. So that means if you think in terms of financially, they'll be indifferent between keeping the existing shares and exchanging them for M company shares. So for P company, there's no difference whether they sell their shares or keep it with them. Because we saw, right, the wealth maximization did not take place. So for B company is not, sorry, for P company is not so much of an effect or impact whether they sell the shares or keep the shares, whether they exchange the shares or keep the shares with them. But in order to encourage P company to sell, a premium would have to be offered. Remember, if you want to go ahead with the accusation, okay, who is buying? M company is buying P company, no? M has to offer a premium to P company. Premium has to be made. If they want to go ahead with this accusation. If no accusation, no problem. But if they want to go, they have to pay a premium, and right, so that P company sell their shares, because for them it's indifferent, no, whether they sell or keep it. So how do you encourage them to sell? By giving them premium in this case. And the last paragraph I have to give a conclusion. What is it? How much offer do you need so that this accusation goes ahead, so that P company easily sell their shares? An offer of, that is what the answer says. You can do your calculation and see why. 2.5:1. An offer of 2.5:1 will give that encouragement for P to sell their shares without paying the premium. Okay, maybe you can do your calculation and see why 2.5. This is what the answer has given. Now, this is not enough. You have to talk about the position of M company shareholders. That is target company shareholder. Don't write in the exam target company or core company. Write the name of the company, because the examiner does not know what is target in this one. I mean, they know, but make it very clear. So in this situation, what happens? For M company, what are the points you can write? No synergy gains. Okay, because there is no synergy gain, what so their only gain could be what? If there is a gain to P company shareholder, it will result to a loss for P company. Sorry, a gain to P company. I'm sorry, M is the acquirer company, not the target company. So for them, there's no synergy gain also. So any gain that is done to the target company will be a loss to the M company, right? So clearly, they do not want to proceed with the takeover in this circumstance. Why? Because they do not have synergy gain also. And if P company is making a gain, it will be loss for M company. So why do you think they will want to go ahead? Don't have a reason to go ahead with the accusation, right? So in this condition, there is no such deal that can be cracked where you can satisfy both the shareholders. One party is going to suffer. Okay, that's for sure. If it's P that is suffering, target company that is suffering, they will not sell their shares. If it is M company that is suffering, they anyway don't want to acquire because no synergy gain is also there. Now we are coming to the last question, that is test your understanding 4. Here is the same similar question you can see. So if the acquisition goes ahead, here synergies are there 20 million. Okay, Vance company have indicated that they would be happy to accept an offer that enable them to achieve 25% premium on acquisition. This is with a premium. Good question. Advise the director on a suitable share for share exchange offer which meets the criteria specified by their shareholder. So this question, I don't think it will take you 2 minutes to do because all this while you've been doing similar question. Right? Can you do it on your own? Okay, let's do. Find out value of L company. Just multiply both. 100 million. Just multiply both. 8 into 5. 40 million. Add both. 140 million. Add the synergy. Will give you 160 million. Now, share for share exchange calculation. Okay. That we have to do here. L company, V company. First start with pre-accusation value always, before the accusation. How much? It was 140. Just now we have done it simply. Then add the premium. 25% on 40. Right? Because we company needed what? 25% premium on accusation. So 25% on that 40. 10 million. And balance of the value gain goes to L. How? How do you do that? Tell me. See, one benefit is synergy, okay? So from synergy, okay, what is the benefit that is going to V company? That is this premium, no? 10. So what is the balance? It is 10. Balance goes to L company. Out of synergy, total benefit is 20. But out of 20, 10 as a premium is going to V company as a benefit. Balance goes to L company. This is how you work out the balance, okay? So 10 million. Now you add up. Post acquisition value. Here is 110. Here it is 50. Okay. Do relative valuation. That means in terms of ratio, whenever you want to find out, divide both the side by this. See, on your right hand side, it should always be equal to 1. That's why you're dividing both by 55. This will be 2.2 is to 1. In terms of ratio, you have to find out. Okay. Now you have to talk, advise. Calculation part is over. What are you going to advise? At the moment, L company has 10 million shares in issue. Okay, 10 million shares. So to make sure the valuation after the acquisition is split in this ratio, remember, after the so to make sure the valuation soon after the acquisition, okay, has to be split in this ratio only, 2.2:1. It needs to issue how much? How many shares? 10 million divided by 2.2, which is 4.55 million new shares has to be issued. That means to give to V company, this has to go to V company. Correct? Now, V company has how many shares in issue? 5. They have 5 million shares at the moment. So in terms of the share, if you go by share for share exchange, they are having 5, but they will get this 4.55. There need to be 4.55 new shares in L company for 5. They have 5. This is the issue. Okay. So just let's find the ratio. That means 4.55 divided by 5. How much it will be? 0.91. Out of 5 shares in this one, this is what they're issuing, which is 0.91. That means 91 for 100 share exchange. This is approximately 91 for every 100 share exchange. This is the meaning of it. So that's it for this lecture. Now we are going to summarize everything that we have discussed. So we started with 2 forms of consideration. Cash, we said that advantages is that no change in ownership. Disadvantages is you have to pay capital gain tax. And how did we finance? Through debt and right issue. Debt is less expensive if you can take the advantage of tax, because lower tax for interest, but at the same time having too much of debt will increase your gearing. Right issue, in a way it is good, no change in ownership, but dilution, I mean your earnings per share will suffer. Coming to share for share exchange, this can dilute your ownership, but at the same time you don't have to pay tax, you can delay the tax payment. And issues that are relating in how which form you take, cash or share for share exchange, there are 2. Number 1, always look at the position from the target company shareholder and the bidding company shareholder. This applies for both share and cash, by the way. So that's it for acquisition and merger. Hope you like this section also very well. And please, now it's your job. I've done my job. Do questions from revision gain on acquisition and merger until you do become a pro in that. Valuation, how do you finance, the rules and regulation takeovers, the defense mechanism, the types of synergies, all those things, all the 4 lectures. So next lecture will be on reconstructions and reorganization. That is a new area for AFM because this has not been taught in your financial management. And also most of the people say it's a very dry area. I mean, it's very boring. It's difficult. It's the most difficult in AFM. I would not say I partially agree with it, but definitely through if you are very good in acquisition and merger, let me tell you, you can equally do well in reconstruction also, because reconstruction and reorganization is the opposite of acquisition and merger. In acquisition and merger, 2 companies you join and they become one. Reconstruction, 1 company you are dividing and it's becoming 2 separate companies. You are selling off, demerging. So opposite of acquisition and merger, we are going to study there. And definitely that section is a small section, so we can quickly finish it in 1 or 2 days. Before I move on to my section A of AFM, that is the biggest section, but it's mostly theory, so I'll be able to finish it quickly. Best of luck for your AFM exam, and please do lots of questions, and thank you for watching. And if you have not subscribed to my channel, please do it now. Okay, see you.